Good evening, everyone. Indo-US Chamber of Commerce of Northeast Florida welcomes you to the Financial Roadmap to a Successful Retirement event. Thank you for joining us online. I would also like to thank our viewers who will watch the replay later. Thanks to our sponsor, Wistar Credit Union, for sponsoring this event. I would like to start with Warren Buffett's two rules of investing. Rule number one, never lose money. And rule number two, never forget rule number one. Money is certainly one of the ways we can turn our dreams into reality. It gives us a feeling of empowerment, freedom, and security. It has been a great pleasure for us to host this event together with Wistar Investment Services just for you, so you can gain better understanding of your investment options and to learn how you pursue your retirement goals. It is my pleasure now to introduce our moderator for this evening's event, Lakshmi Balasubramanian, one of the esteemed members of the Indo-US Chambers Board of Directors. Lakshmi has built a successful career in the healthcare and finance industries for 15 years. She received a bachelor's in engineering from India, a master's in IT from United Kingdom, and MBA from University of Florida. Lakshmi has always worn multiple hats in project management and system analysis that has helped to save time for end users and generate high revenue for businesses. She has developed three key mantras to handle her projects: know your customer, streamline the value chain from business and customers to operations, advocate automation to save time and money. She is currently employed with Florida Blue as a senior project manager. Please welcome Lakshmi Balasubramanian. Mute.
Today, thank you, Ms. President. I'm excited. My name is Lakshmi, and I'm excited to introduce the speaker of the day, Jennifer Pestacek. For us, money is very important, just like our president mentioned. Money plays a vital role. We always need a money manager to help us move forward in our life, and that's the reason we have a finance manager here who is going to help us understand the well-being of wealth, not at this age for retirement. So that is Jennifer Pestacek from Wistar Investment Services. Jennifer started her career with Fidelity Investments, where she started as a broker dealer in retail securities, gradually adding new investment products and strategies to her portfolio. She has a passion for helping credit union members strive to persevere, grow, and manage their wealth through consecutive planning sessions. Her goal is to listen, educate, and understand where each credit union member in his or her financial journey needs a customized plan to help move forward in their lives. Jennifer received her MBA from the Jacksonville University. She holds the Series 7, Series 63, and Series 66 registration with LPL Financials. On the personal front, she is a wife and a mother foremost. Jennifer also enjoys the outdoors, auto racing, and she's a big fan of University of Alabama football. We need to talk about that, Jennifer. In her off hours, she can be found with family, traveling, and enjoying the beaches at Florida. So welcome Jennifer Pestacek, who's going to help us understand how to manage wealth in our retirement. Over to you, Jennifer.
Thank you, Lakshmi. To start, I would like to share some facts regarding Vistar Credit Union. So our president and CEO is Brian Wolfberg. Brian joined Vistar family October of 2017. He leads the fourth largest financial institution in Northeast Florida with over $9 billion in assets, and we serve over 700,000 members. It's the 16th largest union in the country, the 14th largest employer in Northeast Florida, and the largest mortgage lender in Northeast Florida. A large part of how we're really able to capture that market share is really through our vision, which is to be the primary financial institution for our members and to bring credit union services to more people. What I would like to do is share with you, this deck was really put together by Legg Mason for a continuing education for financial advisors. However, A lot of the topics that they focused on will really cover our retirement discussion that we'll have this evening. We do need to disclose before we get started. I want to clarify that any securities and advisory services are offered through LPL Financial. They're the registered investment advisor and broker-dealer member of FINRA and SIPC. So any investment products are not insured by NCUA or any other government agency. They're not credit union guaranteed, not credit union deposits, and they may lose value. However, with that being said, tonight's discussion will really focus on key steps you can take to set yourself up for the lifestyle that you want to live in retirement. This evening's discussion is not going to be tailored towards specific investment products. We're going to go ahead and skip just the next two slides because they're really geared towards financial professionals. Now, I'd like to get into our retirement discussion. What I would like each of you to do is just take a minute here, close your eyes, and imagine what you really want your retirement to look like and feel like. What do you see yourself doing during the course of a day? Is it hobbies you enjoy like fly fishing, spending time with family, traveling, volunteering? Where do you really see yourself spending your time in retirement? Now, think about how you feel in this moment, and let's open our eyes. To really live the lifestyle that you just envisioned, it really starts by being disciplined with your money and building a savings or a nest egg that's earmarked for retirement. There are some key risks that will impact your savings or that nest egg. One key risk is the rising cost of healthcare. Reports estimate that more than half of Americans will really be in a nursing home at some point in their life. So that's a pretty big realization for most of us. We're going to skip slide 10, and now we'll go into another key risk in retirement. That's longevity. We're living longer due to advances in healthcare, and most of us are really just taking better care of ourselves. If we look at the statistics, a 65-year-old man has a 40% chance of living beyond age 85. A couple, both age 65, actually has a 72% chance that one spouse will live beyond age 85. And retirees are likely to live 20 years after they've retired. So we really have to think about those key risks and how they're going to impact our nest egg later in retirement. Another key risk we don't always put front of mind is really inflation. Our dollar in the future doesn't buy as much as it does today. If you look at this chart, if we think about the price of milk or the cost of gas, things are more expensive in the future than they are today, so our dollar doesn't go as far. So it's really important that we're positioning our money to work in a way that's going to grow and potentially outpace inflation throughout our lifetime. There are different things that are important to us at different times in our lives. In our 20s, we might be focused on repaying student loans or saving for our home. In our 30s, we might be making a down payment on a home or covering childcare expenses. In our 40s, we might be saving for college or looking to expand our family through adoption or fertility treatments. So it's really important that during these times that we continue to build our nest egg by contributing to our employer plans or IRAs. It's important to maximize those contributions when we're 40s. If we think about as we transition into our 50s, we might be paying for our child's wedding, our home purchase, or helping our parents financially. In our 60s, we start to transition and think really about retirement, and then how are we going to replace our income and our health care benefits once we do that. In our 70s, we may be concerned about the rising cost of health care and our inability to work due to our health. In our 50s, we need to continue to maximize our retirement plans. In our 60s, we need to talk to a financial professional to really understand our options on taking Social Security, our distributions from our retirement accounts, In our 70s, we need to work with a financial professional to really address our specific needs. Your retirement income will really come from three main sources, which are Social Security, employer-provided retirement plans, and personal savings. You'll find Social Security alone may not be enough income to maintain the lifestyle that you want in retirement. Saving for retirement is really up to you. You can accomplish that through 401ks and IRAs. We also know that you never really know when something unexpected is going to happen. So you have to hope for the best, but prepare for the worst. A well-constructed retirement savings plan can help you do just that. To build that plan, it really starts by figuring out how much income you'll need to maintain your standard of living. And that's different for each of us in how we like to live and lead our lives. You'll see that about 8% of your pre-retirement income is what you'll need to maintain your lifestyle in retirement. So the kind of retirement you enjoy later really depends on how you save. To know how much you can save for retirement, or you really need to have a budget in the household. That's going to be the foundation to really move forward in your financial journey. You have to understand your income, your expenses, and then know what that surplus or shortfall be every month. We're going to skip the next 3 slides because we've already covered this information. And now we're going to talk a little bit about an income gap. And what that means is oftentimes when we go to retire and we're not getting that steady paycheck, we need to think about how we're going to replace that paycheck. There are things that we can do to really grow that nest egg that's going to support us through those retirement years or our golden years. We can save more, we can spend less, we can work longer, or we can change our investment portfolio to be aligned with an appropriate level of risk. We'll find we may not always want to work longer, or we may not be able to save more. So a key factor here that can really impact you, whether you're early in your savings journey or later in life, is really making sure that you understand how your money is positioned and how it's working for you. We call that allocation. Now, in conclusion, I would really ask each of you to visualize how you want your lifestyle in retirement to be. Take a moment, write it down. Consider the key risk like inflation, the rising cost of healthcare, longevity. Really take the time to establish a budget and estimate your income gap. The earlier you start, the better. And always, we would encourage you to reach out and contact a financial professional. We find money and finances are very personal. So your retirement planning starts with finding a financial professional that you trust and that you can be open with. That individual, someone like myself, can really help you identify and prioritize your goals, your needs. They can help you choose and implement financial strategies that are really aligned with goals based on your risk tolerance and your time horizon. But again, that's where you have to take the time and find someone that you feel that you have a connection with, meaning it's your professional, but you need to feel heard and understood, and like that individual really has your best interest in mind throughout your savings journey. If you're not sure where to start to find that financial professional, you can always reach out to ViStar Investment Services or reach out to your local bank in your area, or your friends or family. Who do they work with? What's that relationship like? And that would be a way to really set yourself up now for financial success later in retirement. Now, I'd like to turn the conversation over to Lakshmi.
Thank you, Jennifer. Thank you. That was helpful. So I understand you mentioned setting a budget as a first step to get into personal finance management. Can you talk a little more about that so our audience can understand where do they start? Like for a college kid, where do the college kids start setting up the budget? And for 30s, can you give us some tips about like, hey, where to start?
Okay, absolutely. I would suggest that you, if possible, try to keep your receipts for about 60 days. Or if you like apps, you can use Mint is one app I'm thinking about. Just something where you can really track where your pennies go each month. So we know from our paychecks, we can track how much money we have coming in. That's called income. And then really tracking where we're spending our pennies, we can see the outflow. We subtract the two, and that gives us our difference. So that's either we have a shortfall, we don't have enough to cover our expenses, and then what do we need to cut back on to live within our means to have a surplus or to build that surplus for our savings later.
So you're saying for any activity that we engage in, we handle those receipts, like manage to keep those receipts for 60 days and keep track of it, so that becomes like our budget ledger.
And the
Is that
reason
right?
why I would say keep your receipts for about 60 days, if you're mindful and if you're writing down everything, you're probably not going to be as accurate or as honest with yourself where your money goes. If you just spend like you normally do for 60 days, but really keep those receipts and look back, you'll really see where you could kind of control or better serve your dollars.
Makes sense. Makes sense. Makes sense. All right, I'm going to shift towards the small business owners, and because we have a lot of small business owners as our members, so I'm going to ask on behalf of them to see what will be your advice to them on how to manage finances or how to manage getting support from a financial advisor.
So it's the same as if you're an individual. Reach out through someone that you trust, and a great way to do that is through like your local credit unions. Part of what I love about being a member of the credit union, never forget it's your money. We put you first. So we're not going to have fee-centric advice for you. We're going to put you in the center of everything we do. But again, it comes down to having that budget, especially a small business owner. If you really track kind of your income and your expenses, and you see through whoever helps you do your taxes, how much do you have that you could really save for your retirement later? Then you can work with a financial professional once you've determined how much you have to save to determine the type of retirement plan that would be right for you and your business based on what that surplus looks like.
Makes sense. Makes sense. So pretty much you can start handling, just like handling the personal finance, you suggest small business owners to handle their finances as well the similar way.
Exactly, because bottom line, until you really know where your money's going, how do you know we can protect, grow, or manage for later?
That makes sense. That makes sense. One of the questions that I have as a small business owners always come across is cash is crunched or kind of cash flow is not that much. What is your advice for small business advisors to decide on having a finance manager like you? Would you say, hey, the moment you set up your business, go talk to a finance manager, or do you think, hey, once you have a positive cash flow, go about having a finance manager? What is your suggestion or advice to them?
Okay, advice there would be, as a financial advisor, I look at it as a hierarchy of savings. And what I mean by that, do you have 3 to 6 months of a savings set aside where you could cover your monthly expenses if something happens like COVID? You know, if something happens and your income isn't stable, how are you going to support yourself through those times? Once you have that 3 to 6 months of what I call an emergency fund in place, that's when we can branch out, and then it would be appropriate to work with a financial advisor.
Makes sense. Thank you.
Oh, and one thing I would like to add there, through ViStar and other credit unions may do this as well, we offer what's called a money makeover. You can come in and sit down with our relationship specialist. If you need help creating that budget, they'll go through your receipts with you. They'll walk you through establishing what your financial picture looks like, what that initial budget looks like, and then we can talk to you about there may be ways that we can consolidate some debt, whether it's credit cards, and refinance that to maybe a lower interest rate to help you save. You're not making more money, but you're refinancing your debt in a better way to give you more dollars, to make your dollars go further.
Makes sense. Thank you.
You're welcome. And what other questions may we have from the panel or anyone that's listening with us this evening?
Yes, Amuda is on.
Okay.
Sorry, I was. As a financial advisor, how will you actually measure and evaluate the finance portfolio?
Okay, how we do that, it all starts with a conversation with the individual. We need to learn who and what's important to you. Who are we planning for? What's your time frame that we need these funds? And that gives me an allocation that we can work with. When I say allocation, that lets how much money, if any, we're comfortable putting at risk or for growth, and then how much we need to build in for protection, maybe liquidity, or being able to spend that money down the road. So I never chase performance. It's all about mitigating risk and having your money work in a way that can maximize the return on where you are in your savings journey. So we need to have a conversation so I can meet you where you are in that journey and then kind of guide you appropriately.
Okay. So in addition to that, are there any recommendations you give to the individual, like before they meet the financial advisor? These are the list of things you need to get prepared.
I would say if you can bring in, like if you have a budget in place, if you have your taxes, if you could bring a copy of your taxes, if you feel that that's daunting or too much, all you have to do is come in, sit down with someone and have a conversation, because someone like myself, we're going to know what questions to ask you through the conversation to get the information we need to help you create a financial plan for your situation. It's just like if you're ill and you go to the doctor, you may kind of know where the pain's coming from, but you don't know what's causing it. Once you have a deeper conversation with the specialist, then they can help you kind of determine what we need to tweak or medicate.
Thank you, Jennifer. We have a question from an audience by Prince Kumar. What would be few tools that an individual between 20 and 30 could use for long-term investment?
Okay, did you say what? Could you repeat the question?
What tools an individual who is in the age range of 20 and 30 use for long-term investments? Do you suggest any online tool or any kind of methodologies that they can think about?
Question. So I would suggest oftentimes through your employer, you may have access to a 401k account, or your employer may have a firm that they partner with where the company holds their 401k plan. Oftentimes through those organizations, you get access to free online tools that can help you do some projections. Outside of that, I would then reach out to a financial advisor at like your local credit union and speak with a financial advisor that's not going to charge you fees up front to help you understand your situation and maybe where you should be saving your dollars.
Makes sense. Thank you. That helps. That helps. We have one more question from the audience.
Yeah.
The question is from Kamesh, and the question is, for the instant gratification society, we are in a society where we look for instant gratification on anything that we do. How to start the education to young kids about the world of finance? Where do you think parents or teachers or even anyone can act as mentors to teach the benefit or teach about finance?
I think it really comes from the home, from the parent, the family. That's why it's so important that we get a handle on how to manage our finance in a way that's going to set us up for success down the road, because you don't get this type of education in your local school.
No, that's a good point, Jennifer. I wish we have a few curriculum modified at school, even at elementary level, to talk about economics, to talk about managing personal finances. I know my kid goes to school and he comes back with cheetah cash saying, Mom, I earned this cheetah cash. Then I have to tell him for what purpose. So that's a good point. If we have good education curriculum added to the elementaries or even middle schools, it would be really of great value to teach them about finances, managing finances. Thank you.
Absolutely. And then I would just encourage us as parents, part of why we have a instant gratification society, that's also behaviors that we have to make sure we're mindful of and that we don't display to our children, making sure that they understand the value of a dollar and what it means to work and earn something in your life. But thank you.
Yeah, thank you. Thank you, Jennifer. One other thing I want to always understand about financial planning is, what's the difference between a retirement planning and personal finance management planning? I've heard people say, hey, I'm saving for my retirement. But I keep asking them, hey, are you not saving for the current life? Or how are you managing your finances? But often I get confused. Hey, these two are two different concepts, but sometimes they look like very similar. Can you elaborate a little bit about that?
Yes. So to me, financial planning is really more of a holistic approach to how your money is positioned and working for you for different goals that you may have. So financial planning to me is understanding all of your goals, and then how much money of your nest egg or of your savings are we going to set aside for that particular goal. To me, that's financial planning. And then financial advice is when, based on your goals, your preferences, I'm going to tell you specifically what investment to put those funds in. So one is kind of holistic planning, where we're taking your different buckets of money and aligning them towards your goal. And then the other piece of that is specifically what exact investment will help me get closer to achieving my goal and getting the return that I need for the risk I'm willing to take on.
Thank you. That helps. That helps. One other question I have is about clients. What do you think? How you as client or as a customer of you, how do you think we can reciprocate the due diligence financial services that you offer us? Well, can you explain how that interaction is, or kind of how the monetary conversations are?
Exactly. So I would say it goes back to finding that trusted financial professional that you're going to be comfortable, open, and honest with. Because you can't tell someone what you think they may want to hear to help you meet. You have to do that gut check, that reality check, and tell the advisor, you just have to, and honesty works both ways. So I would say, first and foremost, you have to be willing to get personal to be uncomfortable talking about money with someone that you may not know. And then just being really open and honest, and then be disciplined. As a financial advisor, I have the market to work with, but if, I guess, garbage in, garbage out. So, the plan that I help you craft and create is only going to be as good as the information I have to build upon.
No, that's a good point. It's often difficult to have this finance conversation with someone if you do not know the person, if you do not build a rapport or relationship. So yes, I totally understand. Having that trust and relationship building is very important when we talk about finances. Thank you.
I encourage you to interview a couple of financial advisors. You should be interviewing them as much as they're interviewing you, because you have to be a good match. Because if it's someone that you're not comfortable with, you're not going to give them the information they need to help you achieve your goals.
Mm-hmm. That makes sense. Thank you. I have one question from the audience. I'm going to read it aloud to you. Is there something I can do to be better prepared when I first go to a financial planner? Something I could do to self-educate, or maybe some questions I should be asking myself or the planner?
Two things I'm thinking there. I would like, when someone comes to meet me, again, you're interviewing me as much as I'm interviewing you, and we're finding out information about each other. Find out how long someone's been in the business. What type of clients do they work with? And then when you get that individual's information, all you need is a first and last name. You can go to brokercheck.org. That's brokercheck.org. It's through FINRA. You can put in their first and last name, and then it tells you if they have any disciplinary actions, if there's been any customer complaints, how long they've been in the industry, how many firms they've worked for.
Thank you. That helps.
Oh, and I would also encourage you, if someone wants to charge you a fee to meet with you about your situation, I would steer away from that firm and look one that's going to meet with you. It's kind of like if you go to an attorney, the first time it should be kind of complimentary to see if they're even going to be a good fit for what you need to accomplish.
Thank you, Jennifer.
The question I have a financial goal in place, right? Situations may change, and whatever goals we set before may no longer be valid. So what do you recommend? How often should we actually revisit our financial goals and change accordingly?
So I would say that financial plan that you create and craft, view that or look at that almost like a living, breathing document, meaning it's going to evolve and change over time. Once you have a plan in place, if nothing changes in your situation, at least once a year, you should be revisiting that. But once that plan is in place, anytime that you know your situation is changing, whether you're increasing your income, receiving an inheritance, losing a job, if something's getting married, getting divorced, having children, if something significant changes in your situation, that's when you would revisit your plan. But I would not get caught up in short-term like headlines or the noise. Work with a financial professional, have a plan in place, pick investments that are appropriate for the plan that you've set out, and then manage those. Look at those once a year. Make sure they're right for you at a minimum.
Thank you. Do you have any recommendation on best practices for small business and individuals regarding their finance?
I would say, yes, I would say for small businesses, I think oftentimes don't be so caught up in expensing everything where you don't maybe show that you have the extra income that you could really put away for retirement later. So just, I guess, again, it goes with having that balance there. sometimes as a small business owner or even as an individual, I think we want to get our taxes so low. We want to show such a low amount of income so we don't give the government a lot of money up front, but then that may not give us the best way to take that extra money and maybe grow it for retirement down the road. With individuals, I would say live within your means, have that budget. You know, is putting something on that credit card at 22% interest that you're not likely to pay off in the next 5 years, is that purchase, was it truly worth it? Was it a necessity or was it a desire? If it's a desire, then plan out steps you could take to save towards still getting the product that you wanted. So again, I would say just be disciplined, start saving early, and work with a financial professional, whether you're an individual or a small business.
Thank you. Thank you. That makes sense. I have one more question about a typical scenario any human being could come across. So in your 30s, I remember you showed a slide where college students have their college debt, other kind of fees and stuff. But when you're 30s, you have kind of little more obligations to the society and stuff. So what would be your recommendation? Where do you start? Like if I'm having to manage my personal finances, would you say start with credit card, go about your car loan payment, go about your mortgage payment, and then go about your next thing? I mean, is there any hierarchy that you think people should think about in their day-to-day life while they manage finances?
So great question. I would again start with the budget, make sure that you're saving 3 to 6 months of cash that's sitting in a checking, savings, or money market for that emergency fund. So when you get it, I think it's important that you have an account that you set aside, that a small amount you pay yourself first that builds that emergency fund. Outside of that, I would absolutely, if you have any high interest debt, you want to take any extra money that you have in the budget and you want to be paying down that high interest credit card debt first. Once we've done that, and if you're working with an employer, we want to look to your 401k plan. If your company has a match, take advantage of that. That's like free money. It's 100% return. They're going to match you dollar for dollar. Some companies, all plans are different, but up to a certain percent, they're going to match you for what you're putting in. Then outside of that, if there's still extra money, then you have other ways to save, and that depends on what your goal is. If you're in your 30s and you want to saving for maybe a down payment on a home, we're going to put money in a different type of investment versus maybe we've already purchased the home. Now we're in our higher earning years. We have extra money in the budget. We're maxing out our 401k contributions. Now let's take some money and put that into a separate IRA account, individual retirement account. So again, it all comes down to you really have to meet with a financial professional so we can understand where you are in that savings journey, because there's not one solution that's right for everyone.
Oh, well said, Jennifer. Thank you. That was very helpful. Yeah, thank you. Thank you for that. I have another question tied with, again, human scenarios here. One of my friend, she has been caring for her mother, who's in an older age, and she had been telling me, "Hey, I need to set up a trust account." For me, it was like, "What? To take care of your mom, you have to set up a trust account." So, kind of, can you help me understand what is the trust account and what's the benefit of having a trust account?
Exactly. So a trust account is going to be a legal document that you should have drafted through a professional attorney that's going to create an entity. And what I mean by that, depending on the situation, there could be certain needs that other would need to have taken care of that may need to be under a separate, like tax ID number, things of that nature. So bottom line, if you're considering a trust, I would not go to a financial advisor. I would go to like an estate planning attorney. I would reach out to an attorney. We would want to draft that trust document first. Once you have the trust document in place, that's going to make sure that whether it's income that they're trying to push out of the trust or certain expenses that they're trying to cover within that trust, once those legal documents are set up, then you partner with a financial advisor, that once the money goes into the trust, then that's how we determine how we're going to really preserve, grow, and manage the wealth that's going to accumulate in that trust.
Okay, makes sense. So start with the attorney to have the trust set up, and start with the attorney to have the trust account set up, and then go to the financial planner to see how the finances are going to be managed from that point onwards.
Yes, absolutely.
Thank you. That helps. One other question I have is about the fiduciary duty for financial managers that they have for people, for their clients or customers. Can you help us understand what does that mean? What does that entail? What does fiduciary duty mean?
Fiduciary, that means that I'm going to act with what's in your best interest. I'm not going to put you in a product or a service because it's proprietary or how I get paid. So bottom line, acting as a fiduciary just means I'm going to have your best interest at the core of the planning that we're doing. And all of the advisors at ViStar act in a fiduciary capacity because we're financial advisors.
Thank you. Before we close up, I do have one last question here. What do you think is the single biggest mistakes investors make?
I think they don't start saving early enough.
Okay. So now is the time.
Now is the time, and it's never too late.
It's never too late, right?
But you can never start saving early enough.
Do we have any questions from the audience? Go ahead, Lakshmi.
No, that is right. It's never too late. Even at 60s, if you want to start saving, it's not too late. You just need to have your budget. You should not look back. You should look forward. That's about money, right? Yeah, totally understand. Thank you. That helps. All right. All right. Thank you, Jennifer. I think those were the critical questions that we had today. Thank you so much for taking the time to help us understand about financial planning. So I think we all going to have one more hat into our feather today. It's like, hey, how to manage finances right after this meeting. So yes, thank you so much for helping us understand that. And I'm handing it over to the president.
Thank you, Jennifer, and thank you, Lakshmi, for moderating this event very well. Thanks to all our attendees, members, as well as our event sponsor, ViStar Credit Union, and our volunteer leadership team, both the executive committee and the board members who have completely supported and made this event successful. Please take a few minutes to fill out the survey form. The links are actually provided in the chat. So take a moment to fill up. We would like to hear from you. What can we do better? What are the kind of events you are looking further? So it will help us actually decide accordingly and come up with future events. So it's benefit for the community. So our next event is on December 12th and 13th. It's a wellness weekend event. So the event will cover topics on heart and vein health, women health, nutrition. So we are covering up the variety of topics related to health, finance health, well-being, spiritual well-being, and so on. So it covers overall the health. And so you can get ready for a healthy 2021. So we are looking forward to see you on December 12th, 13th. Follow us on Facebook. We even now have an Instagram account, so follow us on Instagram also. You can subscribe to our newsletter to know more about the happenings within the chamber. That is all, I think. So we are looking forward to connect with you. Thanks, everyone.
Thank you.
Lakshmi.
Thank you, Madam President. Thank you, Jennifer.
Thank you.